All right then, welcome back once again to module number 5, and we're looking at financing options. In lesson number 3, we're going to be focusing on vendor take-back or seller financing options. It is part of the non-conventional financing strategy, but it is so valuable it deserves its own lesson. The thing I love about vendor take-back and seller financing is the creativity that it allows you to have. So what exactly is seller-held financing or a vendor take-back? Quite simply, when a seller sells a property, they agree to act like the bank and they lend to the buyer the money that is required to purchase that property. They may lend all of it or they may lend just a portion of the money. This money can then be registered as a conventional mortgage against the property, registered as a first, second, or third mortgage. It can go up to 100% of the value of the property. It all depends on if there's other conventional lenders involved in the transaction or not. So that is quite simply what a seller-held financing is, or what we call a vendor take-back mortgage as well. So let's talk about some of the advantages for the seller when we look at the vendor take-back mortgage. It can increase their returns for their profits. So the fact that they're able to hold the mortgage, they're able to potentially charge more for the property, but more so they're able to collect interest on the money that's owing to them. That increases their profits. It can also create a faster sale as well. So instead of having to wait for the buyer to qualify for conventional financing and go through all the hoops that the banks and the lenders require, the seller can provide the financing and therefore do it in a much shorter, quicker period of time. Shorter closing period, because it can be done faster. The mortgage can be done faster. You can therefore close the deal much more quickly as well. You're able to negotiate terms that are favorable to both sides. So if the standard interest rate right now is 3%, you might be able to charge 4 or 5% depending on the situation. You can also potentially ask a higher price for the property because you are offering this opportunity for the buyer to have financing the non-conventional way, not having to go through the bank. The buyer may be willing to pay more for the property just for that privilege of having that vendor take-back. You're also able to charge a higher interest rate for their cash. More buyers, you're going to attract more potential buyers to that property as well. So the fact that you are making the terms very favorable, it's going to be much more appealing to a broader range of investors. Because investors typically run out of cash to buy properties, so they still want to buy properties. They can qualify and handle it, but they just simply don't have the cash anymore. It can also generate a monthly income for you as the seller. So if you're looking at liquidating a property and you're going to simply put the money into a savings account and start drawing on that for your retirement, why not keep it in a seller-held mortgage against the property that you are very familiar with and just collect the monthly interest, principal and interest payment from the buyer? It can also help you potentially save on taxes as well. So when you sell a property, you have a capital gain if it's an investment property. If you have this capital gain, you have to pay tax on 50% of that capital gain. Now, in the U.S. market, you are able to defer this capital gain if you reinvest the money into another investment property of equal or greater value within a 6-month time period. However, if you miss that window of opportunity and you're 7 or 8 months after the fact, you're now going to have to pay sales tax on that capital gain. In Canada, you cannot defer the capital gains, so you have to pay the taxes. However, with the seller-held mortgage or a vendor take-back, you can spread the tax payable out over a period of up to 5 years. So if you owe $100,000 taxes, you could theoretically pay 20% or $20,000 taxable income claim $20,000 as taxable income each year instead of having to claim the entire $100,000 in one single year. So that can keep you into a lower tax bracket potentially. Again, that's a question you want to ask your tax accountant to make sure that how that's going to apply to you personally. It's also secured against a real asset. So unlike putting your money into the mutual funds where it's registered in some company ABC, that company ABC can disappear off the stock market. Having your money invested into an asset like real estate, the real estate asset's going to remain there. It's not going to disappear. If it burns down, it's got insurance on it. So that's the beautiful thing about real estate. It's also, if the lender fails to make payments on it, then what you can do is you can foreclose on the mortgage, you can seize the property, take it back, sell it to another person, or just hold it again in order to retrieve the money that's owed to you. Some of the disadvantages for the seller, well, just as it's a benefit to be able to seize the property, you may not want the property, so it could end up coming back to you if the buyer fails to fulfill their obligations with that mortgage. You can also incur the expense of the foreclosure, the headaches, the hassles of having to take that property back, and you don't know what condition you're going to take that property back in as well. You could have sold it to them in pristine condition, but through bad management or just bad life choices, whatever the case may be, when you foreclose on the property and take it back, it could be in worse condition. Therefore, you may have to spend money to bring it back up to good condition, or the market value may have dropped. So that's one of the disadvantages. Now, some of the buyer advantages, you get to negotiate the terms and conditions. So unlike the bank is going to tell you what the rate is, and that's it. With the seller-held mortgage, you can negotiate that with the seller. You can also, with investment properties right now in the residential market, the banks don't like to go beyond 25 years amortization, but there's nothing to prevent the seller from going 30 years or 35 years if they wish. You can also discuss and negotiate if there's going to be any penalties involved or discounts, etc. There's no lending limits. There's no need to qualify like when you go to a bank. So when you go to a bank, you have to go through the whole qualification process. And after you do all of that, then they're only going to lend you up to 80% of the loan to value. Well, with a seller-held mortgage, the seller can go as high as 100% if they wish. You can also use other personal items as collateral. Use other personal items as collateral if there's not enough collateral or the seller's not comfortable with lending it out. So it's a great way to take advantage of equity in other parts of your portfolio as well. It also allows you to purchase properties other lenders don't like. So for example, especially in the commercial market, there's a lot of properties that certain lenders don't like to lend against. And as a result, it makes it very difficult for buyers to buy that property if they can't go to banks and borrow the money. Therefore, the sellers need to be aware of this, and the sellers will quite often offer vendor-held mortgages in order to facilitate the transaction. So it allows you to get into, what would be a good property. It's just unfortunate the bank doesn't see it as a good property. Some of the disadvantages for the seller is that the purchaser may pay too much for the property. Sorry, disadvantages for the buyer. The purchaser may pay too much for the property, meaning that the seller sees that you're in a situation where you can't qualify with a conventional bank or a conventional lender, so they may take advantage of this and say, well, I'll lend you the money, but I'm going to charge you $5,000, $10,000 more than what the property, what I'm asking for. So there is that potential to pay too much for a property. You could potentially become over-leveraged since there's no regulations to prevent you from going up to 100% financing. You could buy the property at full market value, leverage it 100%, and then market conditions could change and it could drop by 10-15%. You then become over-leveraged. The interest cost may be too much as well. So typically, there's a trend that the vendor take-back mortgages charge higher interest rates than what the conventional lenders will charge. It's not necessarily always the case, especially if it's a first position mortgage. In first position, if the going rates are 2.5–3% today, then a vendor-held mortgage could be 3 to 4% as well. So slightly higher cost, but you have to determine whether that higher cost is justified because you can get hold of this particular property without having to go through the conventional lending and banks. Now, a mortgage is a legal document. It's a piece of paper, and it's registered against the title of the property, detailing all of the terms and conditions of a loan between the buyer and the lender, or the seller if it happens to be a vendor take-back mortgage. Now, what a lot of people don't realize is that this piece of paper, this mortgage document, is bought and sold on a daily basis in the market. So what happens is the bankers or the investors will gather together a group of mortgage documents, and they'll bundle them all up, and depending on the preconceived risk of that property or that portfolio of mortgages will dictate how much that bundle of mortgages is actually worth to an investment group. So what happened back in the 2007, 2008 was all of these high-risk mortgages that were created were bundled together and they were sold to investment groups. And when these high-risk mortgages started to default, then the investors realized that they were sold a bill of goods, sold a product that wasn't worth what they thought it was worth. So that's what started the subprime meltdown. And as a result of that, the Dodd-Frank Wall Street Reform and Consumer Protection Act was put in place in 2010 in the U.S. marketplace to prevent mortgages being created in a very high-risk environment. So what was happening before, especially mortgage brokers and mortgage agents, they were putting individuals into home ownership positions through very high-risk mortgages that they really had no right to be involved in because they were setting these individuals up for failure. And when failure took place, that's when the house of cards started to fall down and the subprime meltdown took place. Now, as an individual, can you buy a mortgage? Or can you even sell a mortgage? And if you're able to, who can you actually sell it to? Well, here's a website that you can actually visit where you can buy and sell mortgages. It's much more frequently done in the U.S. marketplace. However, you can buy and sell mortgages in the Canadian marketplace as well. There's no real common website that you can go to and do this. However, there are other private investors who are always interested in looking to buy and sell mortgages. So, for example, I created a mortgage on a property I sold years ago. And through the grapevine, I learned of this individual who was a high net worth income earner, had a lot of money in savings, but he was interested in putting it out there and earning a higher return on his investment than the 3 or 4% he was getting in the bank. So I had a mortgage in place that earned much more than 4%. So I sold him my mortgage document, and he was then able to realize a much better return on his investment. Mortgage brokers also have individuals with private money who may be interested in buying mortgages as well. You could talk to your own lawyer or accountant. They may know individuals who are high income earners who might be interested in buying a mortgage from you. They won't share that information with you, but they may pass along your information to their clients. Now, as an example, I mentioned that I sold a mortgage in the past. It was actually when I sold my business, which was a campground. Now, selling a campground is very difficult because of the financing. Most lenders do not like to lend against a business like a campground. So I was able to sell it to a group of individuals who came up with a percentage of cash, and then I agreed to hold the balance in a vendor take-back, and it was in a first position. So I had a first mortgage against the property. The value of that mortgage was approximately $460,000 at an interest rate of 6% over a 25-year amortization period. Now, at the time that I did this, conventional interest rates were around 5%, so 6% was pretty good for them. That created a monthly payment of $2,943. Now, the question is this an asset or is it a liability? Now, if you listen to Rich Dad, Poor Dad, Robert Kiyosaki, Robert talks about an asset being something that puts money into your pocket. A liability takes money out of your pocket. So based on that definition, this mortgage document that's paying me $2,943 every month for the next 25 years is definitely going to be considered an asset. Now, The next question though is this asset what we call an appreciating asset or a depreciating asset? If I buy an apartment building and it pays me $2,943 every month, over the course of the next 25 years, I'm still going to have that asset and it's going to continue to pay me $2,943 or the equivalent of. Whereas this mortgage document, it's paying me this $2,943 every month for the next 25 years. But 25 years plus a month, and that mortgage document is now worth zero. So it is what we call a depreciating asset. Now just the same, it's a great deal because for the next 25 years, I'm collecting $2,943 a month. I think most people would be very happy with that sort of income on a monthly basis. Then one day I had this realization that I have this depreciating asset instead of the appreciating asset. Plus I have no cash for investing because the cash that they paid me, I used to buy my personal, pay off debt, plus the little bit that I had left over, I used then to buy my house. So it left me with no cash, but I've got this depreciating asset. So what am I going to do? Well, I remembered from my early real estate days when I was a real estate agent back in the early 90s that you could buy and sell mortgages. So I dug up the books, and sure enough, I discovered that I could actually sell a mortgage. Now, the fact that this mortgage was in first place and it already had a good interest rate, so a good return on investment, made it a very attractive sale to a potential investor. That's the key, is if you want to sell your mortgage, you want to make sure you create a really attractive mortgage to sell to another individual. Now, I mentioned that I was collecting 6% interest. The going rates were they were 5%, so it was good, but I needed to make it a little bit better. So what I did was I discounted the value of that mortgage by $35,000. In other words, I sold it for $425,000 cash to this investor. By discounting it, that increased the return on investment to the investor up to 7%, so that's what he was happy with. So I now have $425,000 cash to go out and buy other investment properties. Now, this is a pretty detailed example that I've just touched on very lightly here. During the live events that I host for this particular program, I go into much more detail about this, how this whole structure came to be. Now, buying and selling mortgages led me into this potential scenario. Now, this is a hypothetical scenario. Let's say we have a hard luck purchaser. Somebody who has a great paying, very secure job, but they have no credit and they can't qualify for a mortgage. So I like to say, for example, an individual who's been incarcerated for 6 or 7 years, they've been out of the loop, but while they've been incarcerated, they've acquired this high-skilled job as a welder. Pays extremely well. They get out, they meet the love of their life, they start a family, they want to get a new home. He's turned his life around completely. The problem is, because of his background, he can't qualify for a conventional mortgage, and he hasn't had time yet to build up any sort of credit as well. So then we also find a motivated seller. So now we've got the buyer taken care of. So now we've got a seller who's been trying to sell his house for many months. It's an old, tired house, pink stucco. It's not very attractive at all. It's been on the market for over 12 months, no offers, very little interest. He's ready to give up. So what I do is I approach this seller of the property and I negotiate a price. So he's asking $300,000 for the property. We negotiate a price of $250,000. So he's willing to sell it to me for $250,000. But instead of making it conditional upon me going out and getting financing, what I'm going to do is I'm going to make it conditional upon him giving me 3 mortgages. The first mortgage is going to be at 60% loan to value. In other words, $180,000 amortized over 25 years with an interest rate of 6%, monthly payment of $1,098. I'm then going to create a second mortgage for $75,000 or 25% loan to value, same amortization, slightly higher interest rate, a payment of $670. Third and final mortgage for $45,000, 25 years, 16%, $593. That means that it's now 100% financed on its value of $300,000. The monthly payment for all three mortgages totals up to $2,363. Now, the potential buyer for this property has to be able to afford making the payment of $2,363. He's got a good paying job, so I'm going to assume and talk to him, and he says, yeah, I like the house, I want the house. He can't qualify for anything else, so he's going to lower his expectations and make do with this house. He can paint the outside of it, fix it all up, and he can afford the $2,363. He knows that conventionally he'd be paying less if he went to the bank, but that's not an option for him. Now, what I'm going to do is I'm going to find 3 investors to sell these 3 mortgages to. Now, the first mortgage at 60% loan to value at a 6% interest rate, I don't need to discount it because the going rates are 4%, so the first investor is very happy at 6%, so they simply buy out that mortgage for a face value of $180,000, no discount. The second mortgage, however, I need to make it a little bit more attractive, therefore I'm going to discount that mortgage by $10,000, and that's going to increase the return on investment to 12% for the investor. The third mortgage, the same thing. I want to make it a bit more appealing and attractive to the potential investor, so I'm going to discount it by $8,000. So that means I've discounted all 3 mortgages by a total of $18,000. So now I'm going to collect $180,000 from the first investor when they buy that mortgage. The second investor is going to pay me $65,000, and the third investor is going to pay me $37,000. Now, these could be 3 separate investors, or they could be all the same individual, but they're 3 separate transactions. So I've collected a total of $282,000 from the sale of these 3 mortgages. I have to pay to the original seller $250,000, which is what we agreed upon. That means I get to keep the difference of $32,000 profit. So it's a win-win for everybody. By structuring this very creative deal, I've been able to sell the house for the older gentleman who wants to move out to be closer to his family and move on with his life. He's happy. He gets his whole $250,000 cash. He's not holding any mortgages because I sold all 3 of those mortgages. The buyer is very happy, even though he's paying more for the property than what it may be worth from a financing perspective. He's happy because he's in a home ownership position. I'm happy because I made a profit on putting this whole transaction together. Now, I will be the first to admit, I have not done a deal structured exactly like this. However, I have bought and sold mortgages. And I put this scenario together simply for you to see what is potentially possible and just to get those creative wheels going. Now, when you do a deal like this, you need to have certain clauses in your purchase and sale agreement. So for example, vendor agrees to carry a first mortgage of $80,000 bearing interest 7%, semi-annually, not in advance, monthly payments of $560 for a term of not less than 5 years, amortized over 25. Very standard clause. You also want to put in that this offer is conditional upon the purchaser being able to sell the above-mentioned seller-held first mortgage at closing for an amount satisfactory to the seller, $78,000 minimum or whatever it is you want to put in there, within 14 days, failing which this deal becomes null and void. So again, if for whatever reason I can't sell any or all of those mortgages, I then walk away from the deal within the 2 weeks. However, if I can sell the mortgages, then the deal comes to fruition. Now, this is no different than me making the deal conditional upon 14 days for me to get satisfactory financing to buy it. So it's still got that 14-day finance clause. It's just a little bit of a twist. Instead of acquiring financing, I'm selling the financing. So what you do then is you repeat this for both clauses 2 and for the second and third mortgages rather. Now, if you have a clause for a vendor take-back mortgage, in this case $20,000, an interest rate of 10%, with your payments $178.90, 5 years, amortized over 25 years. So that's a standard clause that you could put in. The purchaser will be given the first right of refusal to buy the vendor-held mortgage under the same terms and conditions he or she would accept from any other purchaser. So what this means, if, for example, I negotiated this vendor take-back mortgage of $20,000 and the seller agreed to it, A couple months after we close, the seller decides, you know what? I want my $20,000. I don't want to wait for these monthly payments. I've got use for the money. I'm going to sell this $20,000 mortgage document to another investor, and I'm going to discount it by $5,000 because $15,000 in my hand is better than a $20,000 mortgage. So if there's an investor willing to pay him $15,000 because we have this first right of refusal, he has to make that offer to me first so that I can buy my own mortgage at a discount. Now, if I can't afford to buy it at a discount, or if I can't afford to buy it, period, then it can be sold to anybody at whatever rate the seller agrees to. This just gives me the opportunity to buy it and save myself some money if I can come up with the cash. Now, you can also structure it so that you have the vendor agrees to give the purchaser a discount of 10% if the mortgage is paid within 1 year, or a discount of 5% if paid within 2 years. Now, you can change those numbers to whatever you want. This is just an example. So quite often, an educated investor, if they can take advantage of a vendor take-back, they will, even if they've got the money themselves. So for example, I've got the $20,000. I don't need the vendor take-back, but I'm going to take the vendor take-back anyways because I may have better use for that $20,000 in another deal. A year later, or 11 months later, I still have that $20,000, and I'm thinking, you know what? Maybe I'll pay off that second mortgage, but I don't have to pay him $20,000. I pay him $20,000 less the 10% because of this discount clause. So these are just an opportunity for you to generate or create a little bit more equity when you pay that mortgage off. Here we have the vendor agrees to hold a mortgage in the amount of $50,000 over a period of 30 years, fixed rate 5 years with simple interest bearing an interest rate as follows. So you can have 1 year interest free. You can have year 2, 3% interest providing 85% occupancy is achieved. Year 3 is increased to 5% providing 95% occupancy. So what happens quite often is a seller will sell a property and they'll want top dollar for it, and they're going to sell it based upon potential rents or potential occupancy. If the property is 40% vacant, then that's what you should be buying the property for. However, you may see some real good potential in this property, and you want to make it a win-win for both sides. So what you do is you structure the deal with a combination of conventional financing and some unconventional financing through a vendor take-back. The vendor take-back can have anything that both sides agree upon. As long as both sides agree, that's the key. So in this particular case, you can tell them, I'll pay you the price you want. However, because it's got such a high vacancy, it's not going to have the cash flow. Therefore, I need at least 1 year interest-free. It could be principal and interest-free for the first year so that you can spend your time and energy on getting it occupied. Then at the end of year 2, if you can get it to an 85% occupancy rate, you'll start making payments based upon a 3% interest. And your goal is to get it to 100% occupancy. So once you get it up to at least 95%, then you'll start to pay him 5%. Now, if they're not willing to negotiate with you on terms like this and be flexible, then you're not going to pay them anywhere close to the full price. So it's all part of the negotiations. Now, if you have a plan to assign this particular contract, you've put a property under a contract, you've got an agreement for sale, or a vendor take-back or seller-held financing clause in there, and it's a really good term. What you want to do is you want to make sure that you have this particular clause in there, which allows you to transfer this mortgage, vendor take-back, to any other person, corporation, or entity deemed suitable by the purchaser. Because the seller has agreed to enter into this mortgage contract with you, not with Joe Blow. And if you assign this contract to Joe Blow, then Joe Blow may not be able to take advantage of the vendor take-back, which then is not very advantageous for Joe Blow, and the assignment of that sale is not going to be as lucrative. You also want to make sure that when you do put a vendor take-back mortgage in place, that you have a clause which allows for subordination. And what this basically means is that the vendor agrees to subordinate their mortgage in the event of any new financing coming into place in the future. So I've got an example of what this looks like. So let's say, for example, you are buying a property and the after repair value is $400,000. You've purchased it for $300,000 before repairs. That means you have a conventional mortgage of $240,000 and the seller agrees to hold a mortgage for the balance of $60,000. You do your repairs and now it comes time to refinance the property. So you go to the bank and you're going to finance it based upon the after repair value of $400,000. So 75% of the $400,000 is a $300,000 mortgage. All you want to do is replace that first mortgage with this new first mortgage. So you take out the first mortgage. The moment you take out that first mortgage, anything behind that, second, third, fourth example, for example, is going to slide up a notch. So the second mortgage is going to slide up into first position. And that means then the new first mortgage cannot be placed in first position. It would have to go into second position. And no primary lender is going to be interested in going into second position, especially at 75% loan to value. So what you need to do when you create the mortgage is you need to have, you're going through the same process where you get the new first mortgage ready to go. You need to have the subordination clause inserted so that the seller agrees to stay in second position. So when that first mortgage is removed, the second mortgage stays where it is, and the new first mortgage goes into first position. Now, like anything else, you need to seek out legal advice when you're especially when you're doing any creative deal. So what you want to do to protect yourself especially is make sure that you make this subject to lawyer's review. And you're going to want to have at least 4 or 5 business days in order to give the lawyer enough time to look over all of the clauses to make sure that your interest is being protected. All right, so that's it for lesson number 3. That's also the end of this module. So again, if you have any questions, please feel free to email them at kbeaton@arcarealestate.ca. I again strongly urge you to hold off emailing questions in before you experience the live webinar. If you want your questions answered during the live webinar, please email them in ahead of time. You do have the opportunity to ask those questions during the live webinar as well. All right, so thank you very much. Look forward to seeing you on the live webinar.